So buying the dip is tempting in a volatile market, but our next guest says, beware of the death cross signal. For more on that, let's go to Martin Pelletier, Senior Portfolio Manager, Trivest Wealth at Wellington-Altus Private Counsel. Martin, what is the death cross signal and who's sending it out?
So basically, it's a technical indicator that whenever a stock price falls below its 200-day moving average, they call it the death cross because it's a major structural signal that the market or a stock is turning in regards to its momentum and turning to the downside. And so when you look at the U.S., for example, the S&P 500, the Russell 2000, big stocks like NVIDIA and Tesla, Disney, Bank of America have all breached their 200-day moving average. And when looking back historically, when that happens, there's anywhere from a 20 to 50% drop, further drop once it breaches that 200-day moving average, and it takes anywhere from 3 to 7 months to recover, to hit the bottom first and then recover. So is this not a very favorable trend that we're witnessing right now?
Okay, tell me, given where we are, and you said it takes sort of 7 months to recover, how much more downside you see from where we are now?
Well, that's what I mean. If I take a look at the S&P 500 back in 2008, when it breached its 200-day moving average, it fell another 30 to 40% from that level of breaching it. And then it took 6 to 12 months to actually hit the bottom. Apple in 2013 fell 20 to 25%. Before recovering, and it took 3 to 6 months before hitting the bottom. Russell 2000 in 2023 fell 15 to 20%, stabilizing and recovering after 4 to 8 months. And then you've got some big moves in NVIDIA and Tesla. And so if this history does play out again, then buying these dips, which investors have been doing en masse, can be quite a dangerous strategy. For the first 2 weeks of April, for example, investors plowed in $21 billion into U.S. stocks and $6.6 billion in levered ETFs last week and $2.2 billion in 3 times levered NASDAQ. So everyone's thinking it's a sure thing that we're going to get a recovery and we're going to see recovery right away. And I'm just saying, well, if that doesn't happen, you want to be careful.
Let me ask you, besides the trade war, then, what are the other headwinds you see this year for investors?
Well, tariffs are the tipping point. It's going to tip a lot of scales into a certain direction. And what I mean by that is earnings. And earnings are going to be impacted. Maybe not so much immediately, but we'll start to see that impact in forward guidance. Tesla's reporting tonight or should be reporting any minute now after the close here. And so we'll start to see some indications as to what forward outlooks are going to be. And so we're at the early stages of that as to how that's going to impact the economy and corporate earnings.
Okay, let's talk about some of your investment options, sort of aside of the uncertainty. Structured notes is one of them. Tell us about them.
Well, historically, bonds have been the place to go during these market corrections. And it hasn't been. If you take a look at bond yields, they've stayed stubbornly high, mainly because of government's financing needs and deficits that haven't been cut back. They're continuing. So if you take a look at a 60-40 portfolio over the last 3.5 years, it's only delivered a 2% annualized return, which is terrible. And so if you're looking at a replacement to bonds, the heightened volatility in the option market in regards to and higher interest rates are providing some really attractive yields being offered in the structured note market as a replacement to the bond market. So for example, we're looking at doing some structured notes on Canadian banks or blue chip Canadian companies that pay 8.5% coupon payment monthly, an annualized return, of course, with 50% downside protection. And so there's some really attractive options in the structured note market as an alternative to the bond market.
Okay, we also heard from the IMF today. They downgraded the outlook for this year, growth outlook for pretty much everybody. And I'm wondering, when you take a look at those downgrades, how do you factor in diversifying globally? I mean, where do you start?
Well, you want to look at the countries are going to be able to recharge their economies, and they're going to need capital, and they're going to need to attract capital. And so if you look at repatriation, the falling U.S. dollar being down, I think it's 9 or 10% from its highs at DXY, and capital returning home back into Japan, into Europe, for example, that capital is going to find its way to the most efficient areas of those markets. And so if you look at Japan and Europe, for example, they can continue to outperform the U.S., which it has done a good job so far. In Canada, our GDP per capita is abysmal. We're the second lowest, just ahead of Luxembourg. So that's not very encouraging. It's something to keep note of with the election and while you're looking at voting. But overall, we see that that trend continuing to move outside of the U.S. into other jurisdictions, and those other jurisdictions will do better or maybe not as bad as the U.S. market.
Okay, can you focus a little bit more on Canada and tell us, for those who do want to just stay in Canada and buy Canada for obvious reasons, where they should look?
Yeah, and so you can do, we like Canadian dividend companies. Companies like the Canadian banks are great. They're going to continue to pay their dividend. They have strong balance sheets. They can withstand a slowing economy, which I think is going to be the case here in Canada. There's value for those looking at active management. We use a manager called Alcometric in Toronto. It's done a phenomenal job for us on our dividend exposure. Owns companies like Alamos Gold, Wheaton Precious Metals, Franco-Nevada, Finning International. So sticking close to home with some of these nice dividend-paying companies paying 5 to 6% dividends and riding out this volatility is not a bad place to look. And then there's also for high torque. We're looking at the Canadian energy space. Not yet. We reduced our position materially in January, but we're looking at getting back in should this sell-off continue.
Okay, Martin Pelletier, appreciate you joining us. I got to leave the conversation there. Thank you.
Thank you. Take care.
All right, we do want to share the new results from Tesla, first quarter results coming in right now. We are taking a look at a couple of big misses. Tesla's actually up in after hours trading, but here's what happened, not entirely unexpected. The adjusted earnings per share coming in at 27 cents a share. The estimate was 43, so that's a big miss on earnings per share. Also for revenue, the estimate was $21.37 billion. Big miss here. They came in at 19.34. A couple of notes from Tesla saying the rate of growth will depend on a variety of factors. Of course, what's happening with the trade war and competition from China. And Tesla saying the tariff landscape will change, of course, and have a larger impact on the energy unit for that company. And Tesla also going on to say it's difficult to measure impacts of global trade policy at that time. We're going to break down more of these numbers when we come back. We're back in a moment.